Hi, Mark Orr from sellmybusiness.co.nz, broker with tobacco business sales and licensed under the REAA 2008. Thanks for joining me again. Episode 2, Business Valuation, the voodoo that you do. 3 fundamental steps in valuation that I follow, and I'm sure the other brokers within the tobacco group all follow something very, very similar. First of all, the business information is collected. This involves the financial information from the owners, which would be a minimum of 3 years full financials, the depreciated asset schedule, currents, internals from MyAB or Zero or something similar as far as the software program goes. We would then do our best to project forward the income that was expected for the current year. And also GST returns for 12 to 24 months. I like also to give us an idea around about the actual true sales, or that can be compared with the profit and loss results. Then we would go out and sit down for an hour or two with the owner as well and go over the background of the business and get a really excellent understanding of it. Firstly, I guess there's a number of various methods of valuing. Most of the time, 99% of the time, we're using an earnings-based method. This is a method that determines the probable future income of a business, and you basically capitalizing the income stream to determine a business's value. And then we would go through and adjust the income stream and just try and figure out the actual revenue against the expense items. And it's universally accepted that in most closely held businesses, the earnings-based method is usually the best and most common used by business brokers, and certainly the most easy to understand. We'd also utilise the market-based method as well, where we're making market data comparisons. Generally, if you're looking at an asset-based method, the notional realisation of assets, if you're looking at it in that way, if the assets of the business are worth more than the earnings-based model, which is capitalised out to an applicable cap rate, if the assets are worth more than that figure, then you're really just looking at an asset sale. So let's kick off with the business information gathering. I follow 12 points, which I think give a good background, and there'll be other aspects that we may ask through the process as well. But these are my standard line of questioning around owner's impact. Number one, what the owner's role is and what their experience. Then there's things like the number of hours that they would do. We'll discuss how reliant on the business the owners are, whether the bottom line figure is determined by their high personal goodwill, or is there a lot of delegation. Staffing, always looking at obviously the number of staff, salary levels, the key staff members, the availability of replacement staff, and the skill sets required. Company history is probably one of the things we chat about first of all, and just finding a bit of background about the business, whether it was a start-up or whether the owner has brought it as a going concern. Financial performance, we covered that. We would then sit down and ask educated questions from the fact that I'd already received the financial information and we'd gone through the profits and losses, and I could ask direct questions about certain aspects of the expenses to make sure that they are legitimate add-backs. And perhaps even look through the balance sheet, obviously, and there may be some evidence of where the money's gone through in relation to the business and the balance sheet too, so just querying those factors as well. Industry type, manufacturing, distribution, import, retail. We would go through that element, which would be fairly obvious, but noting the particular aspects of the business in relation to that industry type. Growth, always crucial. All valuations are done on risk and growth. Industry growth, you're selling horse whips or mobile phones, it's all relative. Sunset, sunrise industries, obviously sunrise industries with a future for growth are going to carry more weight than something that is in decline. Systems and procedures, again, very, very important. Automation of your business, whether it is got great CRM systems, database, whether there's a flow through for the work in progress, and systems designed to automate that process or systemize it for the staff, whether there's manuals for the staff about processes of how to do things, and down to if it's in manufacturing, or there's a process of where recipes are involved, whether it be for the mixing of industrial product or even in food processing, whether that's all written down and documented for someone that can come in and buy it and just run with it. Lease and location can be important in certain businesses, such as retail. Position may be very important to their overall sales. We would look at the reassignability of the lease, whether the market rate they're paying is reasonably fair, and any other aspects within that lease that might be of an issue to a buyer. Customers, whether they're databased, who they are, where they're from, whether there's some that are more important, i.e. the 20% or more of the income. Are they contracted? Are they reoccurring? Again, all important aspects in relation to the overall value of the business. Suppliers, whether there's rebates, any kind of relationships and agreements, service contracts. Is it easy to get what you need to supply your customers? And also whether there's any seasonality either in the overall business or in the supply of those inventory products. Plant and equipment, is it modern? Is it old? Is it well repaired? Is it derelict? How much capex expenditure is someone going to have to come in and spend an awful lot of money to grow the business, or at least even when they come in just right from the get-go, is a whole lot of plant and equipment going to be replaced? That will either discount or maximise a business's value also. Good quality plant and equipment always support values underneath, in my opinion. Business environment. Lastly, is it recessionary? Are there any government legislation issues, imports affecting the particular business? Is there any regional issues? All these things, again, are very important in the valuation process. As mentioned, we take an accountant's figures and we add back to profit any discretionary spending. And in smaller businesses, we would generally add back depreciation as a non-cash expense. But there's tons of other things that may also be applicable. Interest, things like personal insurance, if you've got health insurance included, but it's actually personal. Car use, perhaps. Things like travel, which is not actually applicable to the business. Legal expenses, perhaps employees have been removed and that has cost them in a one-off payment. Bad debts, things like that. Things that are one-offs that aren't actually totally applicable to a year-by-year expense profile of the business. And we also will do some takeouts. Sometimes in smaller businesses, things like partners or wives are involved in it in an administration role or some other role, and they're not accounted for in relation to wages. So there may have to be 15 hours subtracted per week, and that would make a material difference to the overall earnings of the business. There are two styles of businesses and profits that we sell. Me regionally here, I do a lot of the EBPITDs, the earnings before paying one proprietor, interest, tax and depreciation. These are ones where we're allowing for one working owner's income, and also the add back of depreciation, and as well as givens, and then there'll be probably some also add backs for those tightly held sort of smaller companies. There's lots of other expenses that are generally discretionary. And then larger businesses, EBITs, the earnings before interest and tax, there's always an allowance made for an owner's wage at a rate that's expected for a manager in a business of that industry, and an allowance for a replacement of plant and equipment, be it the depreciated asset schedule values and the book value that's left there, or something else that's more appropriate for that particular business. Okay, so we now move on to, we've got all the information together and we're going to go through and analyse, and ultimately what we're trying to achieve for the business owner in completing a valuation is to give them a value range, a fair market value range, and to do this we need to first establish profit, which is what we've hopefully done through analysing the financials. We have the qualitative data in regards to the business about the intangible sides, which we can compare to other like businesses that were valued in the past, and we need to try and establish some kind of capitalisation rate or a multiple of that future maintainable earnings stream or profit that we've already assessed. And a cap rate is generally based on the historic information we have on a similar business or similar businesses that we have sold in recent history. So, for an example, after analysing a manufacturing business which has 10 staff, the first step being we've ascertained that the profit after adjustments is in the range of $270,000, and this is an allowance for an owner's wage at $80,000, and also for the reinvestment of plant and equipment at a suitable rate. And then the next step is we will have to head off and compare with historic sales data to try and find an applicable cap rate. So in market comparison, we would try and compare like-to-like businesses, and in this case we're comparing a manufacturing business. And I would put a caveat in here. These are for illustrative purposes. We're just these figures are older, and we have achieved up to 4 times for these specific businesses, but again, they're just here for illustration. So in this illustrative case, we've assessed, and we'll zoom in a minute, but the range of rate of return on investments in this particular range, and we've got 1, 2, 3, 4, 5, 6 businesses. Historically, we were able to achieve between 21% and 29% as far as a capitalisation percentage, and through using the qualitative data that we've assessed in this particular illustration, we've got a gut feeling, and it's never a science, it's always an art. So there'll be aspects in relation to the owner's impact or staffing, or whether the systems aren't up to scratch. But in this case, we're saying it's in the bottom end of this particular grouping at 26 to 29%. So if we just zoom in quickly, so here we've got the business type. They're all basically manufacturing or something similar. These are the sale values that were achieved. The intangible of the sale value, so this is the component in a sales and purchase agreement outside of the plant and equipment and inventory. And as you can see, there's quite a high value of intangible above and beyond the actual assets or tangible assets of the business. And then on the far side, these are the EBITs. So 250, we established ours with 270 or so, ranging from 110 right through to $1 million. And then the capitalisation rate, or the return on investment in relation to the sale price that was achieved and the actual EBIT, ranging between 21 and 31%. And here we are deciding that for our particular business, we're going to sit between the 26 to 29% as a cap rate, which is very strong. So the EBIT 270, the historic range is 26 to 29%. So if you're dividing that by the 270, you end up with a range between, as a fair market value range, between 930 and 1,040,000. If you bring it together and you were looking at a sales and purchase agreement, and in this particular business, we're saying that plant and equipment is worth 200,000, probably a book value for something at an EBIT. For an EBIT business, generally, it was how it would be transacted. Stock on hand at March 31st of whatever year it was, or whenever it was taken over at assessment, is 120,000, and the intangibles are 68% of the total value. Or if you're looking at the return against the intangible assets, you're looking at 2.5 times, and that also is plus a wage. So thanks, that's episode 2, business valuation. We covered in this particular episode the collection of the information, where we sit with an owner for an hour or two and discuss the qualitative side of the business, all the aspects that make up the who's, what's, where's and how's on site generally, so we've got a good feel for the actual physical business itself too. We look through and analyse the business information, pull it all together, head off to our database and look through historic comparables, find an applicable cap rate, and then apply that to it to multiply out value range for someone, to give them an idea of what their business would be worth on the market today. So far we've covered in episode 1 the return on investment. It's your money and what kind of return you should expect or could expect from various vehicles, be it just interest-bearing deposits, property, or in this case, we're interested in going concern businesses. Just had a look at the valuation and how is the asking price arrived at. It's not really rocket science. It's just a matter of going through the process of assessing the business, getting a great feel for the intangible side or the value or the qualitative aspects, looking at the financials, and then making a comparison against our database of sold businesses to give people an idea about what they can achieve. Episode 3 we'll move on to next, which will be an explanation of what intangibles and what they are, which I think is very interesting, and in comparison to goodwill and intangibles is always a bit of they're pretty much interchangeable, so that'd be an interesting aspect, and I hope you can join me in episode 3 and 4. Just questions that a good business broker, probably elaborating more on the actual analysis questions that we ask, and other aspects that you should ask when buying. So I hope you can join me on episode 3. Thanks for listening today. It's Mark Orr, your host from sellmybusiness.co.nz, a broker with Tobacco Business Sales, licensed under the REAA 2008. Until next time, best of success.